I'm still using question 27 to look at the application of the equity method. And in this video clip, we're going to see the entries that are passed by the investor if the investor does not prepare consolidated financial statements. So that means the journals are actually passed in the investor's accounts and not on a group level in the consolidation worksheet. Now, before I look at the calculation and the journal entries, I always find it quite helpful just to draw up a timeline to see and to plot the information that is provided in the question. So if we look at this question, the equity share was acquired on the 1st of July 2011. So this is when the investment was made. And we're busy with the financial year end 30 June 2013. So there was one financial year end in between, 30 June 2012. Now from the acquisition analysis, the one adjustment that we have to make to our calculating our share of the associate's profit or loss relates to pre-acquisition adjustment for depreciation. Now we know that the fair value adjustment that we made in the acquisition analysis was to the value of $15,000 after tax, and the assets that it related to had an expected further lifespan of 5 years. So over 5 years. This gives us a depreciation charge of $2,100 per year, and we've got a 30% share in that, so $630 needs to be adjusted for depreciation that relates to pre-acquisition equity. This will be for year 1 and then for year 2. And there will also be a 630. Then of course for year 3, 4 and 5 and subs in the future. And we'll also make this adjustment. So these are pre-acquisition equity depreciation adjustment. In the question, they also gave us information on inventory that was purchased by the Bell Limited and that was still on hand at the end of the financial year. They purchased it from the associates. So for the current year, we had inventory costing $100,000 on hand at the end of the year. For the previous year, it was $60,000. And a profit before tax of $30,000 in the current year. For 2012, $10,000 had been made on the sale. So therefore the profit that's sitting in inter-entity inventory transaction after tax was so it was $30,000 for the current year, so after tax it's $21,000, and the previous year it was a $10,000 profit, so after tax it's $7,000. So this is a realized profit because we make the assumption that the inventory was sold in the following year, and this is inventory on hand at the end of the year, so that is unrealized profit. Remember that similar to group financial statements, any unrealized profit resulting from transactions between the investor and the associate is eliminated, so that the results that is brought in into the investor's accounts only reflect transactions with external parties, external to that group structure or that investment structure. Further to this, we also got information about the profit of the associate for the year. And then they told us all dividends may be assumed to be out of the profit of the current year. Dividend revenues recognized when declared by the directors. So we'll look at that when we draw up the journals. Further information on the equity of the associate at the financial year end. And then there were two other entries: an asset revaluation surplus made from the revaluation of freehold land at the end of the financial year, and a general reserve which arose from a transfer from retained earnings in June 2012. So we also have to take into consideration then the asset revaluation of 30,000. The general reserve, there's no adjustment that needs to be made. Whether an amount, if the associate transfers an amount from retained earnings to a reserve like general reserve, there's no need for it to be treated or adjusted for in the current year, because the investor already recognized his share of the equity in the retained earnings. So he's already accounted for his share of the retained earnings. So the increase in the general reserve resulting just from a transfer from that retained earnings does not require that he needs to recognize that increase in the general reserve, because it has already been done.